Good day, fellow investors. Let's take a look at Nestlé today. Nestlé is a global food and beverage leader in 180 countries with a diversified portfolio, stable demand. Major shareholders include obviously the big pension funds. BlackRock and UBS are the top ones named in their annual report. They have strong brands, global trust, massive scale, integration, everything you need for a big moat for long-term sustainable advantage. Although private labels could pose a risk to them and pressure their margins, so that's something that we'll have to keep in mind. Management drives, in theory, portfolio optimization and rebalances the portfolio for more growth. We see this with other large brands such as Unilever, we talked about a couple days ago. And management also drives a consistent dividend history, focusing on each year, growing the dividends and buying back shares. Although there will be a catch on that, which I'm sure you will be excited to see. On an intrinsic value estimate, I'll talk about in detail, but I think they are worth around 47 Swiss francs per share. It all comes down to the growth expectations you have. I try to use a conservative number, and we'll see that. They have a large debt, but in theory manageable if interest rates stay where they are. Steady dividends and a moderate risk from private label as mentioned. So looking at their overview, one of the largest beverage company and food companies, you can see them as Nestle. If you scroll Twitter or now X, you'll see every now and then a picture of these giant food companies that like 10 companies own all our food brands. Nestle is one of them. They had some rough historical moves, controversial history, and some comments about water being a human right by a previous CEO. So if you're interested, you can look that up. They operate globally, basically everywhere. They have a broad portfolio, as you can see on the right. From coffee to nutrition to pet care. They focus on health and well-being. This is a new higher margin area they jumped into. They have given their anti-cyclical nature, they are a defensive play, so that also explains why you see a lot of pension funds owning these kind of companies, because they provide a nice dividend yield and a stable dividend, usually growing, so you can, in theory, buy these sort of companies as bonds, probably as an inflation hedge bond, because they have pricing power to a degree to push on inflation costs. And the significant buyers are pension funds, and they don't have any large like family or something that who just controls 50% of the shares. From a breakdown by region, this is from their annual report, trading operating profit. You can see that North America is the largest, followed by Asia, Oceania, and Africa, Europe, Latin America, China, and then they break down other areas, not just by region, but by other segments in the same table I used. So Nespresso is huge, and something that's curious for me is unallocated items. So I haven't made a deep dive analysis on what those are, but I suspect them to mainly being headquarter and management related, and my bad feeling comes from it that okay, maybe one of these sectors have hidden costs allocate in this area, but overall this would be the view. On the company's moat, they have a strong global balance, which means consumer trust and loyalty, which means they have a high like hidden equity basically in the company. Brands are hard to measure how much they are worth. They have massive scale and distribution channels to keep costs down. They integrate vertically, driving efficiency and quality controls. So these are really important because in these type of products, you want to have consistency. So if I buy an espresso in Europe or in the US or in China, I want it to be the same. Every time I buy it, I want it to be the same. And they are also heavily investing in R&D to keep ahead of the curve. Their R&D costs of the revenue is almost 2%. That's relatively high for an industry that you wouldn't think of being an R&D driven player, but more like an old school type of food business. But of course, if you think about their major expenses are mostly marketing and administrative, but they spend way more on marketing and than on R&D, which is actually not only happening in food, but if you would look at a couple of pharma companies, maybe we will do, they usually also spend most of their costs at marketing. From the management's perspective, so they have Mark Schneider since 2017 as the CEO. They want to focus on high growth, high margin sectors. We heard that before, like Unilever, selling of ice cream and buying in more of personal care. Portfolio reshaping, yeah, same story. Health brands is higher margins. If you go to any store, you will see the new hype, be it a couple years ago, alternative milks or no fat 10 years ago, or those kind of things, which today are changing with US Secretary of Health and all those things. Now you have fat coming back in as healthy, other things coming out. So it's always a moving area. And they have a consistent annual dividend and buybacks. Their dividend history is famously, I think, on their website. If you look at their dividend history, it starts with 1959, and they are growing, trying to grow it every year. But of course, they want to keep up with inflation, so that makes sense. Their management incentives for a European company, first, is really transparent, and second, they are not as ESG heavy as you would have expected. So on the short-term side, they are mostly financial. In their compensation report, you will see a more detailed breakdown, but their financial objectives on the short term, basically the same as their long-term incentives in general. And then you have some ESG. So let's look at the long-term underlying earnings per share. That makes sense. So if your business can grow, let's say 1-2% a year, but you also buy back shares at, let's say your business profit grow 2% a year, and you buy back shares at a 2% per annum rate, that's 4% per EPS growth. That's not bad, that's great. So that's how you can kind of juice your EPS. Of course, we'll see how those buybacks worked out. So this incentive will show you something on the next slide that I think is really funny when I found out. So keep this in mind. Earnings per share. Total shareholder return ties in with this on the next slide. Total shareholder return, right? It's the stock price and the dividends, and they measure it against peers. And the return on invested capital, I think this should be basically the highest. So these two are okay, but I think they should more focus on their invested capital. Because if you don't do that, and then you focus on earnings per share and total shareholder return, this is what you get. Look at this. First, just consume the chart. You have free cash flow in green, 12 billion, 10 billion, 9 billion, 6, 8 billion. You have these free cash flows coming up. All right. Then you have the dividends and the buybacks. What you will see is if you, let's say, you add up these two, this is way more than the free cash flow. If you see this is way more than the free cash flow. Way more than here, obviously way more than the free cash flow. What is going on? The secret is debt. This company was basically borrowing money to pay dividends and buybacks, and they still do. So if I don't know if this is how sustainable this is. They started relative low debt, below 100, and then now you are 173, I think. You will see in the next slide. So this is amazing. They truly embrace low interest rates, and they basically went deep into debt, like unbelievable level of debt. Of course, they have a low volatility consumer business, but this is still lunacy. So this pushed up earnings per share, right? Because between 2018 and 2024, their outstanding shares dropped by 14%. So that's like 7 years. So that's like 2% a year on average removed outstanding shares. So you have earnings per share growth, and then you have total shareholder return growth. But this is not a sustainable way to do those things. The sustainable way is to grow your business. But if you look at their business, 11 billion, they have less free cash flow today than they had in 2018. So that if I think about their guidance going forward of like 4% plus, we'll see on the next slide, revenue growth. Okay, guys, sounds good, but I don't see it in your past 7 years. Maybe they have now a structural shift because they know that, okay, we cannot just like borrow and buy back because sooner or later the company is going to go bankrupt if we do that. Let's see if they actually fix this and bring it to a more sustainable path. So let's look at their margin of safety valuation. So intrinsic value, I think, is like 47 based on a 10% discounter. Always use 10%. And I used 2.5% going forward annual growth rate. Actually, in the past 7 years, from 2018 to 2014, it was basically flat / negative. If you just compare 11.5 to 11, right? And then you had some like drop years, basically. So maybe this is even too high to say like, okay, because their guidance is 4% in normal market conditions. And in 2025 first half, they grew at 2.9 there, and this is revenue. Okay, can I? Yeah, 2.9 in first half 25, and this is revenue growth. So this is not, if you look at their cash flow from operations, it grew actually a couple down years, but it actually grew a bit over the same period. Then they were basically flat. So can they pass on costs? Maybe the private labels are hurting them more than others. Maybe the 2.5% is a bit high. Maybe we should not use the discounted cash flow, or maybe we should just use the 10 cap for last year, or the 7-year average cap maybe is a more cyclical. If they don't grow, if they do grow a couple percentage points, it goes up. So 47, maybe even too optimistic. Maybe it should be like 40, 42. Let's look at their profitability. Return on equity is higher over the 7-year average, wasn't higher in 24. Of course it was, because they borrowed from, they borrowed a lot of money, so that you have less equity that you get your return on. So if you have 10 billion in profits and 100 billion equity, that's 10% return. But if you borrow a lot of money and then you have 10 billion in profits against 50 in equity, that's 20%. So you doubled your equity, return on equity, with the same amount of profits, but now you have debt. So if you look at the return on investment, it's basically where it was. Return on tangible assets, right? So it's all the assets, which is basically all the investments part, all the assets minus goodwill, so all the brands and other intangible items. So that's also basically flat. Debt to equity, like this is crazy. Like, oh, the 7-year average, including this high number, is 110 debt to equity, and now you have 173. Cost of debt is surprisingly low. Of course, it's a Swiss company, so they can borrow cheap. And of course, the debt went up, not because they borrowed more, really, just because you have higher interest rates today than you had in the past 7-year average, because you had really low rates. You had negative, actually, bank rates in Switzerland. Coverage ratio, right? So how many times can they cover their interest payments? 9.6, down from the 15, of course, because they have way more debt. Even if interest rates is kind of the same, they have way more debt, almost double the debt than the average is. And their current ratio is kind of the same, although they are a bit less liquid. But for this business, you don't really have to hold that much current assets. And let's look at the stock summary table. So Nestlé, I have here on the bottom. Today, or the last time I think this is today number. It's trading, I think, above the market, the intrinsic value of the company. So you have a lot of debt. These numbers we looked at, but overall, this is a profitable company, above average profitability, and it's a really stable business. That's why pension funds hold. They have a 4% dividend yield today. Their payout ratio is usually around 70 to 75% of net income. So this company basically is just paying dividends, and hopefully if they could find a sustainable path to do that, pay down debt and increase margins and keep on growth. That would be great. Of course, the big question mark is their debt. And of course, at this, so it's not a secret that their valuation is so high if you borrow a lot of money to buy back your shares for 7 years. So that will boost your share price. I think this is overvalued. If there would be a crash in Nestlé below intrinsic, not even intrinsic value, right? Because for that you need 2.5% growth. So if this company would crash down, and they would turn around, it could be an interesting investment. At this point, I wouldn't think about it that much. Thank you for watching. If you enjoyed, please like and subscribe and leave a comment below. Take care. Have a nice day. Bye.